Welcome to the Self Storage Show, where I have conversations with my industry friends, talk with owners and vendors, and share tales about my management company, 3 Mile Storage. Let's go. Hey guys, thanks so much for tuning into the Self Storage Show. Hey, right at the top, I want to talk about something that's really valuable. You don't want to miss out on it. It's 3 Mile Domination. What this is they optimize your Google business profiles, okay? And we all know for self-storage, we live and die by our rentals. I guarantee you, if you don't have your profile optimized, you're losing out on rentals every single day. So go to 3miledomination.com. Right now, they are doing free audits of your profile. You'll see the big red button right there. Book your free audit right now. Book a time. We'll go through your Google profile optimization session in real time together, send you back reports, so you have an action plan. It's very valuable, okay? So again, go to 3miledomination.com and book your audit right now. Hi, everyone. This is Jim Ross with the Self Storage Show, continuing our interview series here. These have been fun to do. I got Brandon Grebe with me. He's the principal and co-founder of Uplift Development Group. What's up, Brandon?
Hi, Jim. Happy to be here.
Good. Thanks for volunteering. I know I was reaching out, kind of getting some more people that are on this side of things when it comes to self-storage, and you graciously accepted. So I appreciate it.
Yeah. Always happy to talk storage with other peers. Absolutely.
Well, really, we're just gonna jump into it here. If you don't mind, can you give us just a little Cliff Note version of you, kind of your journey in storage, and then we'll get into your development group.
Yeah, absolutely. So our company is Uplift Development Group. We are based out of Colorado, kind of the Front Range, just north. Our office is north of Denver in the Fort Collins area.
Yes.
And we've been in business for 7.5 years now. So started really focusing a lot on development. Over time, has added acquisitions. So currently we have 58 properties under ownership, and we really focus in the Sun Belt arena states. So properties were as west as Arizona, through Colorado, obviously our home state, Texas, and then kind of following that Sun Belt trajectory over through the Southeast properties. So we're a relatively small shop comparatively. We'll do 4 to 5 developments every 12 months. We'll do historically 5 to 10 acquisitions every 12 months. Current market conditions are definitely pressuring that, but yeah, overall. And then we do a lot for ourselves. We also work for some third parties. We'll sell occasionally. So we're truly opportunistic, just out trying to find the next good deal and execute on.
That's great. If you think 58 properties doing 3 or 4 developments a year is small shop, sign me up. That's amazing, dude.
Well, and I guess we run lean. It's I started with my business partner, like I said, 7.5 years ago.
Yeah.
On our development company, we have a few key employees, kind of vice president acquisitions, vice president of development management, and then we have controller, senior accounting, some staffing on the books. But I guess we're not a big outfit per se. Kind of like we were talking earlier, just lean and mean. We do have a affiliate general contracting company that builds for us and for third parties, as well as kind of a steel fabrication operation. So it helps us streamline on our developments, that's for sure.
So what's the kind of breakdown? Is it mostly development now? Or do you buy an existing?
Yeah, so a few years ago, we went on a streak of acquisitions.
Yeah.
When money was cheap and things were good and everyone looked smart. So our acquisitions probably outpaced the development 3 to 1. But on average, and definitely current market, we're probably almost about a 1 to 1 for development to acquisition, or maybe a 1 to 2, where and acquisitions for us are value add. So expansion plays make a lot of sense because we have kind of that in-house contracting capability. Of course, everyone's looking for the holy grail, mom and pop operated, no website, type of operational value add. But so we've acquired 4 so far this year
Nice.
on the acquisition side, and we're under construction or in development on our 5th. So kind of a balanced approach in today's market.
No,
Um,
that's-
Developments take so long that
yeah.
we take a long ball approach. Like if I'm actually looking for development sites or working on them now that we hope to start 2024. One of them is probably projected to even start 2025. So very far out from the current economic conditions. Always trying to balance current trends and future costs.
How you kind of playing that right now? I mean, with that many locations, that's great, but it sounds like you want to keep your foot to the pedal to the metal to keep growing here. But the economics right now might be playing. You got some headwinds
Yeah,
to deal with. How's that treating you?
it's real. It's tough. And honestly, the biggest challenge. So the challenge is not. Finding sites is always a kind of a science and art, and that's a whole podcast in itself. But just like once we have a site under contract and development, if it's a 1 or 2 year development, that kind of just has a process that goes through. So economic conditions we're paying attention to, but really where the rubber meets the road is when we get a project ready to be funded. And that's where the challenge is right now in the call it the capital stack. So both the equity, cash, and the debt loan or lender side.
Yeah.
And we're currently going through it. We're working on a deal in Austin, Texas that is going to loan committee today, actually, for a new development. So we will find out what the lenders are saying, but that's where it gets challenging. Is we've worked on it for 2 years. We're tracking rates all the time
Yeah.
as far as on the storage side, but I mean, and it still pencils with a higher interest rate, but it's definitely real of when interest rates go from 3, 4, 5, 6, 7, 8. We got a
Yeah.
quote for 9% on a previous deal, so that's where that's where it gets tough, and I think a lot of deals aren't making right now. So we're getting laser focused on our current deals and making sure they can pencil in the current environment.
What's it kind of like? I'm curious when it goes to the loan committee. Do they just ask questions and you have a chance to bounce back, or they just like rubber stamp it and say no? What is that like?
Yes, yeah, it's a good question. So loan committee is kind of the final vote on the project and we work with like regional size lenders, banks, and we work with conventional debt still. So
Yeah.
typically how the process works with like a bank or lenders is there's a get to know you period, especially with a new lender. If you have existing relationships, that get to know you period is shortened, but they want to understand who you are as a company and your track record. So it's called a sponsor, kind of who's sponsoring the project. Are you qualified? Are you competent? What's your track record? Show me what you've done, history.
Yeah.
And then from there, then they kind of look at the actual project. So they want to see all your feasibility reports, your pro forma, whoever's operating it, their operating expense for the years, and then a lender will go get their own appraisal. And this in today's environment, this process takes longer because not only are bankers underwriting the project, but they're also underwriting us as the sponsor. So they want to make sure that we are capable of backing the project uh, from a financial standpoint as well as a reputation standpoint. But really, they're underwriting us financially because for personal guarantees. So that is an in-depth process in today's environment. I mean, they are dotting I's and crossing T's of, and that can take 1 to 3 months depending on how fast it goes. So that is it.
I was curious. I was wondering, like in today's market, when you get some of the people are just getting into it, if these like loan committees, if they're requiring people with a history of management expertise, what if that's kind of being more of a stress now in this environment?
We're definitely seeing it. Lenders want the surest thing possible. Or let's put it this way: lenders are getting more conservative. So that they might have taken a risk 2 years ago with someone who's getting into it, so a new sponsor or maybe a new market they're not familiar with. What we've seen is all that have gone away. So they want a really clean box for the project to fit in. So they need to know and like the market. They need to know and like the sponsor. The deal has to be very strong financially.
Gotcha.
The capital source where the money's coming from has to be strong. So they're trying to do risk mitigation themselves by not giving a loan to a thin deal.
Yeah.
And so they're very conservative on that. I mean, we we get it underwritten all the time for our projects, but the last few, they've done a much deeper dive of our personal financials to ensure that we can support the project. So, yeah, I'd say for first time people, know that going in, it's going to take a long time to get to know you process with the bank, and then the rubber will meet the road. And so either that person or group needs to be well positioned financially, or in the case which you're not, which I started, just find good partners on kind of investor capital side who will come alongside you and really appease the banks early on, because they're going to definitely want some financial backing in today's environment.
Oh, that totally makes sense. And that I would imagine with as many locations as you have, probably vertically integrated. I would assume you got all kind of management systems in house, so you can show that as being your sponsor. It's all
Well,
you're the,
yeah, so
you're the expertise.
yeah, so I mean, we're vertically integrated on the development construction side for sure. We actually made a decision years ago now to outsource our management. We started doing management ourselves when we had 8 to 10 properties, but our geographic footprint kept growing quickly, and our management just wasn't set up for that. So we made the switch, and so we use third-party property management. It works for us because they can go wherever we find a good deal.
Yeah.
So I'm a big believer of kind of staying in our swim lanes per se, and so we focus on finding good deals and executing on them. And then the management we partner with, but it's a third party property management company that then manages it and specializes in that arena.
Nice. That good to hear. Because again, as part of me a third party management, I'm always like, hey, you find your lane, you have your area of expertise, stick with it. So it's nice to hear. It's nice to hear that.
Well, and as I mean, everything is getting more specialized, whether it's technology, SEO, AI, but even human resources, employment laws. So I think to be a good manager, probably have to specialize in management, and we just we don't have that capability in house, where we specialize in site selection and entitlements and tough developments. The one in Austin, for example, is 2 years in the works. And then we're finally getting close to it, but it takes a lot of time and effort. So trying not to spread myself or my employees out too much, to get too thin.
I'm curious, since you're much more involved in this and probably have your finger on the pulse more than I do. I just keep hearing, people talking about guys that got in deals, like when you said you could do no wrong, and they were just kind of green lighting everything. Do you see right now that some of these deals that were made a couple of years ago might be coming back to bite some people in the butt? Might be an opportunity for people like you to come in and buy them, but I was just curious.
Yeah. I mean, we talk about it, and you and I are talking about it. There's probably 50 lunches happening right now. People talking about trying to have some vulture fund or opportunistic deal, trying to find broken deals. So my personal opinion is, yes, I think there will be some deals that are going to struggle and are in trouble. And what that means is they are not capitalized enough. So really the only time a self-storage deal will fail is really in lease up, when it's burning more money than it's making. And that's going to be because of the loan costs, so the debt payment, then operational expenses.
Yeah, got it.
And then in that period of time, so say a lease up, and maybe it's a slower lease up because market changes, that happens, is when the owners or investors, whoever's involved, either didn't capitalize it correctly at first, or they run out of money. When, you know, right, when there's a burn rate, when the property runs out of money,
Yeah.
and the person or people group can't properly fund it. So that's when the deals will struggle. And no doubt there's going to be some, because of so many deals that happened 2 or 3 years ago, and variable interest rates coming due. But with that said, we're always looking, and we're one of probably 50 groups our size. And then you get to the next tier of owner operators. You know, I guess what I'm trying to say is there's a lot of money still pursuing self-storage deals.
Sure.
And as soon as someone gets wind that there might be a discount, there's going to be capital circling pretty quick, which then creates a competitive environment. And then maybe, you know, it's not such a great deal all of a sudden anyway. So yeah, I mean, I think what also we're going to see is actually going forward, it's just not as many development deals actually come out of the ground. I think that's going to be the bigger story than these broken deals that, I mean, the last thing a bank wants is to own a property, and again, there's so much capital. Capital will pick it up and do great, but I think the story is going to be less development on a go forward basis, because it's hard to even get one started right now. I mean, interest rate of 7, 8, or 9%, depending on what you have to pay investors or capital, because they want a higher return, because they can now put their money into a CD at a bank and earn 5 or 6%. So got to pay more than that to invest in self-storage or any real estate. So I think the new development attrition rate is probably going to be the highest that we've seen in the last cycle, for sure.
Yep. It's definitely, just from in my little world, I've just seen it kind of stagnate. they're on hold. Let's just put it that way. There's a lot of
there's a lot of terms. Hey, let's put it on hold for a while. Let's shelf it. Let's circle back. Let's, throttle down and we're not immune to that. Our pipeline is not as robust as it has been in the past, because it's hard to find deals that can clear everything, including, knock on wood, hopefully a loan committee later today.
I wish you luck. I'll cross my fingers.
Yeah, thanks.
This is good mojo doing this.
We'll have to do a follow-up of either the success story or me crying to you about, why it didn't work.
We'll do a follow-up for sure. Just curious, how you guys are doing these developments? Do you try to get investors? Do you do like investor funds? How do you guys get the capital raised?
Yeah, and I mean, people can do it different ways. So we work with a different company that we're not in partner with on the operating side, and they are a capital company. So they're called All Pro Capital. They're based out of Colorado Springs, Colorado. A great outfit, and we've really worked with them over since our inception, and they've grown up as we have grown up. So they do a lot. They do the majority of our capital raises, and so it's a third party group that we just have a strong relationship with. We trust them, they trust us, and there's good pushback on every deal about underwriting and lease up projections, and making sure, today's conversation, a lot of it is making sure proper contingency is being carried. COVID, one of the things was construction pricing that was escalating so much, so trying to forecast that. And then, every once in a while we'll do different deals. We've done joint ventures. We've done, some investors have 1031 money, so it's called the tenant in common. So we've done all sorts of different deal structures, but we kind of work with a capital group for the majority of our deals.
Oh, if you have relationships like that, you use it and leverage it. So that sounds great. You guys have that already set up. It's awesome. Well, just kind of looking at the time here, we've covered a lot in a short period of time, but I do want to do part 2. I think just kind of talk about that loan committee and kind of walking through that. I don't know. I find that interesting. Maybe nobody else does, but I like it. So we can do a
Yeah. Well,
part two. I think it's cool.
Yeah, better or worse, we know the process pretty well. So happy to kind of do a deep dive into that. And maybe it'd be helpful, especially if someone's looking to get into it, just so they can understand what the process is and really getting the proper paperwork and documentation ready. I mean, it's kind of a full audit of the individuals involved and the project. So the
I would
cleaner,
like that. There's an idea.
yeah,
We're gonna do part two, kind of do like a deep dive into that, and that kind
yeah,
of and that'd be
oh,
awesome.
yeah.
Well, thank
Happy to do it. Love it. It sounds great.
We'll do that. So people that are listening to this, if you're willing, if you want to maybe get some more information, reach out to you. You mind giving out any contact info?
Yeah, happy to. And I'm always happy to, I mean, I'll take any call, whether it's, I talked to the guy the other day who's just looking to kind of understand self-storage for the first time, up to institutional capital groups, so with that said, probably the best place is our website. So it's, our company is Uplift Development Group. So upliftdg.com has information about our company, who we are, and then it also has my contact information on there, both email and phone number. And like I said, always open. It's a great industry, happy, a lot of good people share insight. I try to post on LinkedIn, even just about, we're doing a 4-story building construction, so basement and the 3 up. So trying to share some of those tips and tricks. But so our website would be the best place to reach out.
All right, I'll make sure I put that in the notes section. All right. Well, thank you so much, Brandon. We'll have to do this again.
Great. Hey, yep. Thanks you, Jim. Talk to you soon. Bye.
Before we wrap up, just a quick reminder. Do you want to level up your storage game? Visit theselfstorageshow.com. Grab some high-value freebies, check out top vendor spotlights, and stay in the loop with our newsletter. Do you want to chat about becoming a client with 3 Mile Storage Management? All the info's there. Plus, if you've got a story to share, we're listening. Everything you need is at theselfstorageshow.com.